So with Bitcoin back up near $20,000 per coin, it's back on the radar of a lot of people who wrote it off as a fad in early 2018. And with the gold rush comes a host of companies promising you the potential to make some cash.
So I'm gonna be showing you how to make quick money in one day online.
Many of you may have heard of BlockFi, which is a platform that does just that. The self-proclaimed future of finance promises an interest account that will earn over 8% APY, as well as a way to borrow against your crypto and a few other ways to turn your crypto into an income stream for yourself. But what's the catch here? Well, in this video, I'll be breaking down everything you need to know about BlockFi, how they're making money off you, and whether it's a safe platform that you're going to want to use. Now, if you're excited for that, don't forget to scroll down, click on that like button, and let me know in the comments below what your favorite flavor of seltzer is. I'm a big fan of this cranberry lime, but I'm curious to hear what kind of seltzer y'all are drinking. Let's get into it. So let's start off with the basics of this BlockFi interest account. Essentially what's going on here is you are depositing your cryptocurrency into this interest account, and BlockFi is paying you an interest in cryptocurrency. You can also deposit stablecoins into this account, which are pegged to the value of typically the US dollar. Now, currently there's 8 different cryptos and stablecoins that BlockFi currently accepts, and I'll toss those on the screen right now, along with how much interest you're going to be earning from each of these various currencies. So as you can see, you can earn anywhere from about 3% all the way up to about 9% from this BlockFi interest account, depending on what kind of cryptos you deposit and how much of them you are putting in, which right off the bat is pretty nice compared to what you're going to be getting from a savings account, even those high yield savings accounts, which are currently looking at below 1% across the board. And this is one of the reasons why BlockFi seems so attractive right now. I mean, most people are looking at these savings accounts, seeing interest rates like 0.5%, 0.6%, looking at BlockFi, seeing like 10x that, and they're like, why would I not just keep all my money with BlockFi? So that's what we're answering in this video. But a few things to know about this interest account. They have the ability to change their rates every single month. So this is the same across any kind of bank. Their interest rates are subject to change every single month. With BlockFi, it's kind of based on the price of these coins, supply and demand, etc. Historically, they haven't changed the interest rates too much, but it is just something to keep in mind. You're also able to choose what kind of cryptocurrency or stablecoin you want to receive your interest in. So you don't receive your 8.6% interest or whatever your interest rate is on your particular coin in US dollars, you receive it in a particular cryptocurrency or stablecoin of your choosing. So you could take your interest on your Bitcoin in USDC if you would like to, or any combination of different cryptos and stablecoins. One thing that's really nice about BlockFi is it is available worldwide, okay? So as long as your country is not under sanction, you can use BlockFi, you can deposit your crypto, and you can start earning interest, which is huge for countries that don't have access to a very stable banking system or that are experiencing hyperinflation. But now let's come back to the idea of comparing a BlockFi account with a savings account. So in general, I think you're not really comparing apples to apples here with this type of comparison, because with a traditional savings account or with your typical like Robinhood investment account, these are going to be insured by the federal government, by either the FDIC in the case of a savings account or the SIPC in the case of an investment account. And essentially what this means is if you've got a savings account with Chase Bank, okay, and your money were to disappear or Chase Bank were to go under or whatever, you're going to be protected. That first $250,000 in that account is guaranteed by the federal government. You are going to be getting that money regardless of the state of Chase Bank. Same thing with an investment account with your Robinhood portfolio, with your Fidelity portfolio. You're protected up to the first 500 grand of assets. So if something were to happen to Robinhood, the government is going to step in and make sure you get your money. This is not the case with a BlockFi account, okay? Crypto does not have FDIC insurance or SIPC insurance, okay? So if something were to happen to BlockFi and you had your crypto with them, you are subject to potentially experiencing a complete loss, okay? And this is one of the most important things that you need to keep in mind is when you are dealing with BlockFi or any kind of crypto, there is the potential for a full loss anytime you take crypto off of a hardware wallet that you own, that you possess. Anytime it comes off of there, goes to one of these exchanges, one of these accounts, there is the potential for a complete loss, okay? And I don't think a lot of people realize this when they're just signing up for BlockFi, sending out their crypto, getting their interest rate, that they don't necessarily think about the fact that if something were to happen to BlockFi, we'll talk about how likely that is, you have the potential to experience a full loss. So that being said, I don't think it's particularly fair to compare the 0.6% that you're getting from Ally Bank or whoever to the 8+% that you're getting from BlockFi on a particular apples to apples basis, just because you're looking at a different set of risks here. One more thing to note here about the account before we dive into how they're making money and the risks is that you're limited to 1 withdrawal per month of crypto, 1 withdrawal per month of stablecoin. Beyond that, you're going to be assessed a fee, which I'll toss on the screen here, depends on what you are trying to withdraw. And there's also some withdrawal limits on top of that, but they are very high, so you probably won't need to worry too much about that. So now let's talk about how BlockFi actually makes money, because they're not running a charity and they are a profitable company. So essentially what they're doing is they're following the traditional model of borrowing and lending. This is what typical savings accounts do, okay? They pay you an interest rate and then they turn around and lend out your money at a higher interest rate and pocket the difference. So if Ally Bank is giving you 0.6%, they're turning around lending out your money for 2.6%, then they're pocketing that 2% difference. That's what BlockFi is doing here. They're paying you a set interest rate, again, based on their schedule, and then they're turning around, lending out your crypto at a higher interest rate and pocketing the difference. Now, who would be willing to pay more than like 8% for the ability to borrow crypto? Well, there's really 4 main categories of players that we're looking at when it comes to who BlockFi is turning around and lending your crypto out to. The first of which is going to be arbitrage traders. So since the market for crypto is not perfectly efficient, there are ways to exploit pricing differences between different exchanges or between different markets, or really just capitalize on these very small pricing differentials between different places. And so these arbitrage traders are finding these price discrepancies and then capitalizing on them, so they need to borrow crypto basically to have enough liquidity to execute on these transactions. The second player here are margin traders. So there are a host of people who want to trade cryptocurrencies on margin, basically leverage their results. So they are willing to borrow crypto from BlockFi at a higher interest rate in order to transact on margin. Third, we've got over-the-counter market makers. So some people want to transact in Bitcoin, but they don't want to do it on a typical exchange. So what they do is they transact on these over-the-counter markets. So these over-the-counter markets, they need access to lots of crypto. And so what they're going to do is they're going to go to somebody like BlockFi, they're going to borrow the access to a lot of crypto, and then when people come to them to try to transact, they are going to have access to plenty of crypto to facilitate those transactions for them. And then fourth, we've got large investment firms, crypto ATMs, and other businesses that want access to large volumes of crypto liquidity, who are going to be willing to pay that premium to borrow from BlockFi. So that's the basic business model. As you can see, there's no real hidden cost to you as the consumer. They're basically just capitalizing on the same business model that most big banks use, where they essentially arbitrage the returns of giving you a smaller return and then lending out your money for a larger return. So now let's talk about the risks, because there are 2 big risks that you need to be thinking about if you decide to do business with BlockFi. The first of which is that their loans go into default. And given that BlockFi is in the business of lending, they are in the business of risk mitigation, okay? Because anytime you lend money to someone, you gotta make sure you're getting paid back. So BlockFi does a couple things to kind of raise the certainty of themselves actually getting paid back. The first of which is that they over-collateralize their loans. And essentially what this means is, say someone wanted to borrow $1,000 from BlockFi and guarantee their loan with Bitcoin. Okay, what they're going to do is, instead of just asking for $1,000 worth of Bitcoin to secure the transaction, they're gonna ask for like $1,200 of Bitcoin to secure the transaction. And so they're gonna have more collateral than the actual asset. So if the person were to walk away with the $1,000, BlockFi's got $1,200 worth of crypto that they can liquidate in order to not lose money on that transaction. But given that crypto is so volatile, there is the potential for that $1,200 worth of Bitcoin that they received to significantly fall in value, because we've seen crypto have some pretty wild price swings in the past. So in order to mitigate that, the second thing that they're doing is they have the ability to essentially call your loan at any point. So similar to a margin call, BlockFi can call up anyone who is borrowing from them and say, hey, we either need the money back or we need you to add more crypto as collateral for this loan. So say you got your $1,200 worth of Bitcoin, BlockFi does, and then that drops in value to $800, okay? And now you've got $1,000, BlockFi's only got $800 worth of crypto. You could potentially just walk away because you've got more in value than they have. So from your point of view, there's not a ton of incentive to stick around. But so what BlockFi does is, before it gets to that point, like say your crypto is now only worth $1,000, they're gonna ask you to re-up and add like $200 more worth of Bitcoin in order to make sure your loan is still over securitized. But The real issue here is that if there is a significant correction in the market, either across all cryptocurrencies or most cryptocurrencies, or even just in Bitcoin, there's the potential for BlockFi to face some serious losses. If things start falling very quickly, people start defaulting on their loans, there is the potential for things to go south for BlockFi. But so far, we haven't seen anything like this actually happen, and BlockFi has demonstrated an ability to really manage their risk effectively. Now, the second major risk that BlockFi faces is getting hacked. And like I said before, anytime you take crypto off of your personal hardware wallet and transfer it out to any exchange, any account, there is the potential for hacking, and there's the potential for a complete loss of your crypto anytime it leaves your personal hardware wallet. So in this case, your crypto is going to be as safe as its custodian, which is Gemini. BlockFi does not hold any private keys. All of your crypto will be stored with their custodian, Gemini. And Gemini keeps 95% of their crypto in cold storage and the other 5% on hot wallets that are insured by Aon if a loss were to occur. They're also regulated by the New York Department of Financial Services. So this is a company that has some very solid legs that it's standing on. But again, like I said, there is always the risk of loss whenever you transfer out your crypto. In this case, I would say it is relatively small with Gemini, but there has been over $1 billion worth of crypto stolen from exchanges over the last decade. So it is important to keep in mind the fact that, again, you can lose everything. I want to reinforce this so that people don't think that you have a guaranteed investment here with BlockFi or any other account promising you a return on your crypto. And just for some context here, BlockFi was actually hacked in May of 2020 through a SIM swapping incident, but there was no private information lost, there was no crypto lost, but there was some client information that was exposed. So these companies aren't invincible. They do have a lot of security measures in place, but there is always the potential for hackers to get a hold of your information and potentially steal some of your crypto. So all that being said, would I personally use BlockFi? Well, yes, I would, but I would do so knowing that there is a chance of a 100% loss with anything that I transfer to them. Investing in general is always a balance of risk and return. So given the increased return that BlockFi is promising, it makes sense that there is more risk there when compared with a traditional FDIC insured savings account. And so just comparing the 8.6% that you see with BlockFi to the 0.6% you see with Ally and saying that BlockFi is better is incorrect in my opinion, because you're kind of comparing apples and oranges. You know, I could say that over the last 30 years, farmland has returned 11.5%. And savings accounts have not. So I could say that I'm better off keeping my emergency fund in farmland because it's going to be earning more. And so that's just incorrect, because the point of an emergency fund is not to earn more interest, it's to be readily available. And with farmland, you can't just sell that when you have a flat tire, you know? So you have to really think about your different goals, your different strategies, what you're working towards, and then match your investments with those different goals. And that's the whole point of investing. You know, it's not just put all of your money into the thing that has the highest interest rate. It's like you have to find a balance between what your goals are long-term, short-term, and the different asset classes out there. So I think that there is totally potential for BlockFi to be a part of a well-diversified portfolio, but I don't think it makes sense to keep your emergency fund there or any kind of funds that you are heavily relying on in order to maintain your lifestyle. But let me know what you think about BlockFi in the comments down below. And the next thing you should do is click the subscribe button down here and check out this video over here where I go into everything you need to know about another popular financial service. I'm sure you're going to enjoy it, so click on that video and I will see you over there.